If you just tell me the good news and the upside, I'm going to assume there's only downside. When I like when sellers, even if you go to a car dealership and someone tells you you're not going to like this, your trust in that person grows. I don't know the psychology reason behind that, but you do trust operators that share their bad news with investors. I met with some investors in Palo Alto last week, and they asked me, please tell us about your bad exits. Like, yeah, I mean, our average IRR is plus like 25% IRR. But not all of them are going to be like that. We had one that was a 10% IRR. Are you going to invest in a 10% IRR?
Quick favor before we jump in. It always surprised me that a large percentage of people who listen to the show regularly haven't yet subscribed. If you're a commercial real estate operator, investor, or builder who values conversations like this around deals, capital, and technology, please take 2 seconds and hit subscribe. It's a simple, free way to support the show. My commitment to you is that my team and I will continue bringing you higher level operators, stronger conversations, and real execution level insights every single week. Thank you. I truly appreciate it. Welcome back to the AI Edge podcast. I'm Louis Fernandes. This show is for real operators, capital allocators, and disciplined deal makers, the people who are actually deploying money and taking risk in commercial real estate. Today's guest is Eitan Holder, focused on acquisitions and capital raising, recently closing Lakeshore Plaza in West Palm Beach, alongside a growing portfolio of retail and industrial assets across major U.S. markets. This episode is about conviction, underwriting discipline, certainty of close, and what actually separates operators who win deals from those who just analyze them. Eitan, welcome to the show.
Thank you very much, Liz. Good to be here. And thank you very much for reaching out on LinkedIn. I'm a true believer of the LinkedIn reach out. I try to post as much content on LinkedIn just to be top of mind, but we're really real people buying real things. And it's all a matter of sending a message and making things happen. So thank you.
Absolutely. Eitan, when someone asks you, what do you do? How do you answer that?
That's a good question. So I do have a title, VP of Capital Markets, but I do source deals. I source capital. I talk to property managers. I manage projects. So I'm I merge the asset management position, investor relations, acquisition, all in one.
I love
So
it.
I do
Eitan,
a little bit of everything. That's why I hope to ride the AI wave correctly and have AI help support my business. But yeah, that's what I do.
wonderful. You are a underwriter first, a capital raiser first, or an operator first?
It's a good question. I think I'm an acquisition first because what excites me is deals. I do like to engineer a deal that I see a raw data and I can envision an exit or a good return to our investors. So I'm acquisitions first, and I have a very close and good network of investors. So I'm investor relations second. So what I do is very simple. I connect the dots between a deal and capital, and then I supervise the asset management afterwards.
Beautiful. You posted about losing a deal early in your career because you negotiated against yourself. What changed in how you show up on today?
Well, today when I make an offer, eh, I have so much conviction that the broker, the seller, or the investor is aligned with my vision and feels the certainty of close. So when I look at the deal, I look at it from so many angles, like the macro level, the population density, projected growth, average household income, to see if the demographics align with the tenants or projected tenants. then property level, a type of capex that it needs, the tenant mix, the visibility, accessibility, and then at the end of the day, the returns. Now, I talk to tenant reps to get the market leasing assumptions. I talk to our insurance people to give me the right quotes. So at the end of the day, I know exactly the NOI going in, the NOI moving forward. So by the time that I make an offer, it does send conviction. It does share certainty. And that's how you win deals. Because at the end of the day, a broker, when he's representing a seller, he's saying, listen, I have this 1.5, let's say, for example, $1.5 million offer, but this one from Eitan is 1.5. But I would pick them because they have a track record, they move quickly, they can hit the ground running with legal eh, hitting as soon as we sign the PSA. So certainty helps. And when you're starting and you don't have a track record, or you don't make the mistakes that you're supposed to make, or at least learn from those mistakes, then you don't even convince yourself that your offer is good enough.
You talked a little bit about conviction. What does conviction actually look like in a room with a seller?
Good terms on the offer, being ready to move forward with hard money, sometimes after a week or two, just being ready with every question that they have.
How do you know when you've underwritten deeply enough to walk in with certainty?
When I stress test every scenario, a potential tenant leaving, then having a 12-month vacancy or 6 month, or having to offer TI to tenants that even have a lease that expires in 5 years. But maybe I see the units, even though the lease expires in 4 years or 5 years, offering, well, I don't want to give too much like inside information, but sometimes you can just ignore that lease expiration, offer them TI, renegotiate a better lease going in. And one thing I love about real estate is that you can have inside information. Like, you can actually talk to the tenants and ask them, like, hey, how are you doing? What are your plans? Would you stay here if, let's say, the landlord offered you to improve the roofs or the floors? You listen, it's common sense. So if a tenant tells you, yeah, I love the location and the foot traffic and the visibility, but the tenant next to me smells so much weed that it scares off my customers, then you can engineer your results. So when I look at a deal, it's a raw deal. Every operator has its own way of looking at it. And I love it. There's so much creativity, so much freedom. And that's why I love acquisitions. That's why when you ask me, what am I? I'm first an acquisition guy, and then the rest. If the deal is good, then yeah, sure, you can have demand from many investors, but they have the luck to be part of our organization. And not to sound arrogant, and I really don't want to sound cocky, but a good deal has a good demand. Having a good deal in hand is the most important, is the hardest thing to do and to find. Investors, there are plenty of investors. Obviously, there are investors that put $5 million or $10 million checks. They have a different priority, but there's plenty of investors out there.
If you had to define certainty of close operationally, what does that mean in practice?
That's it. Knowing the type of TI and cost of improvements of every aspect of a unit, maybe having better cost of improving stuff. Let's say good GC connect and network, also being in touch with a certain market's reality. For example, I can have a deal in Dallas, Texas, in a sub-market where I know very good tenant reps, and they are hustlers. They cold call every business out there. So their market leasing assumptions that they provide me are different than what another operator or another buyer will get from just searching on LoopNet and getting, okay, and maybe my projected market leasing assumption are $20 a foot, and I can assume $3 in CAM. But our connections are telling us, connections that we trust, by the way, tell us, no, you can actually get $24 a foot, you should assume that the cam expenses are going to be 5 or even $6 a foot. But we have already like 3 tenants in a like on the waiting list. It's all about connections. And when people say it's not what you know, it's who you know, I mean, you have to make that connection. You have to really bring that network and give you the golden nuggets that help you improve that certainty. Just make you a better buyer. Like your leasing agent, your property manager, or your cousin that just know the area can make you a better buyer and can make your deal, your financial vehicle, more appealing to investors. That's just my 2 cents.
I love it. Eitan, let's talk a little bit about Lakeshore Plaza. What made that deal worth leaning into?
Love the macro. I'm very bullish on the West Palm Beach area as a whole. I mean, first of all, I saw like the foot traffic of Forest Hill Boulevard, over 40,000 vehicles a day, projected growth of over 30% in average household income within the 1 3 5 mile radius. It was densely populated. We saw the surrounding area, and not just, I'm not talking about downtown West Palm Beach. Like it's a completely different world. So knowing like Related and all of those developers are building new developments, I already knew that. But the nearby developments, nearby new tenants in nearby grocery anchored centers, like a Publix southeast of it was bringing more national tenants. I think it was Kiki's Breakfast. There was a new multifamily development. Trader Joe's just signed a lease like 2 miles east of it. And also, I had some connections with developers that I know that were developing high end luxury warehouses or like high end cars. That's for like from a macro. From the property level, first, the basis made sense. On like a cowboy math, if you buy something at $155 a foot, you put $10 a foot in capex, and you could rent it out for mid 20s triple net, it should give you like on your back of your head, like buy it, buy it, buy it, buy it. Mm, it was 30 something percent of the GLA, their leases expire within the first 3 months, and they don't have any renewal options. So we can basically go improve the property in 30% of the leases, bring to market. And the metrics, I mean, we typically solve to a plus 9% cash on cash over a 5-year term, plus 18% IRR, and the numbers penciled on our model. So on a macro, check. Property level, check. Returns, check. We bought it. And it's doing very well. I'm still working on like turning over, like stabilizing the deal. It will take some time, but I'm excited now. We're getting ready to work on the landscaping and the painting, and I'm excited.
What risk did you underwrite that others might have ignored?
That's a tough question. For the most part, I have to be. I'll be honest here. I mostly saw the upside. I did underwrite a much higher property insurance because we had, especially in Florida, we had a rough last 3 years of property insurance just going up from, I remember, like close to $1 a foot, then $1.25, $1.50, $2 a foot. Some operators get $3 a foot. We use our umbrella policy, got a decent. I mean, so to your question, I did underwrite with much higher property insurance, much higher trash collection, much higher painting and capex. We went pretty conservative on those. And then once you close, then you try and fight those bids and just be very specific on every single bid and not just accept the first one.
What was the execution risk that kept you up at night?
Well, it's not something specific to Lakeshore. I mean, there are many deals that go up and down, finding out that there was a dry cleaner 15 years ago, and that the lender that we picked, and we couldn't pick another one because we had little time for DD that required a phase two. Then we end up doing a limited phase two because of a dry cleaner that was in the property 15 years ago. But it happens in every single deal. It's a roller coaster. So you have to have thick skin and not celebrate before you close.
Multi-tenant retail versus single tenant. You've written about preferring diversification over binary risk. Walk us through that thinking.
Hey, you did your homework. You read my post. I love it. So good job on good questions. I prefer to have to buy multi-tenant because if one tenant leaves, then you can still be over 90% occupancy. With single tenant, if one leaves, then you're at 0% occupancy. But I mean, we would buy single tenant, and we're looking also at a shopping center with a vacant anchor that is taking more than 50% of the total GLA. So I see it almost like a single tenant, but the way you go after that is by increasing the certainty. So if you're buying at a very low basis and you have a tenant in place and you already know the type of TI that they want, you calculate the leasing commission and everything lines up in pencils and it's in good real estate, then you go for it. But those cases are rare. What am I offering to my investors by buying a single tenant Chick-fil-A deal for a 5% cap or 6% cap? They can just buy a bond, less risk. And I bet that there's going to be people that will tell me, yeah, but the depreciation, whatnot. But again, if you're into real estate and especially investors that put their money into syndications as limited partners, they want risk adjusted returns. Risk adjusted return is not 6%, at least 8% cash on cash with depreciation and an option to get 18% IRR in 3-4 years. Otherwise, they wouldn't need you, or they could just buy their own stuff.
When you normalize reserves in long-term CapEx, how does that change the headline cap rate?
Oh, well, uh, that's a tough one. I don't think there's going to be an operator that will tell you to the dollar exactly the amount of capex that a property needs throughout a 5-year term. Some investors they just put the like this and figure out, okay, ballpark 200,000 or 300,000. For the most part, it's let's say 50 cents on the dollar per square foot as reserves. Many underwriters, like even institutional capital, they put 30 cents per square foot in reserves. How does that change the cap rate? I don't know. It all depends on how the property looks, the amount of work that it needs. At the end of the day, you look at the yield on cost. I think yield on cost is one of the most important metrics to look at. And if the yield on cost is at least 200 basis points over the exit cap rate, then you're looking at a good deal.
Fantastic. Let's talk a little bit about capital raising reality. You raise capital for these deals. What do sophisticated LPs actually care about right now?
Track record. It's just one thing, track record. I had an investor give me a list from ChatGPT. I get 50 question list, almost looked like an SAT exam. And it was his first um, investment, end up putting 25K or wanting to put 25K. our main baseline. They just care about track record.
What if you're new in the business? What if you're new and you don't have much of a track record?
Well, that's the biggest paradox in real estate. How do you get deals without a track record? How do you have a track record without deals?
Right.
You do joint ventures. The thing about real estate is that you can leverage track record by leveraging someone else's experience. When I first started, I joined a group or very high net worth individual, and I told brokers, listen, I'm working with this person, and our experience, our track record, we've done this X, Y, and Z in transactions, or
Nice.
we have 170 million in assets under management. We're doing JVs right now with a group that has a much bigger track record than us. I mean, we're not the biggest company out there, but we're always looking to grow and buy bigger stuff. And I'm sure we'll do a JV for a deal that we're still not qualified to buy. Let's say there is a $100 million portfolio acquisition. Maybe we're there, maybe we're not, but we would basically do a JV with an operator that has the track record and the ability and the loan guarantors for that type of loan and the operational track record and the investor base. So it's all about leveraging network. You don't only leverage debt.
We're still talking about LPs. Are the what are they most sensitive to in 2026 that they weren't in 2021?
It all varies. I don't know if I can talk about the entire LP community. The most important thing for them is track record. I think after COVID was a big event that changed everyone's opinion on how they view real estate and the type of assets. So most of our investors, they want to see that the tenants are COVID proof. Like even though COVID was once in a lifetime almost, but it had a big impact on people's mindset. So seeing nail salons, mom and pop type tenants, that's a good thing. Even though some of them they don't have a national credit, those tenants during COVID, they were the ones that asked for a rent relief. Mom and pop kept going. So I mean, from the investors that I talked to, they asked for mom and pop. They want internet resistant and restaurants with or or businesses with good Google reviews. That's something overlooked. Like when I look at a deal, and I'll try not to give too many advice to my competitors, but Google reviews are extremely important.
I agree. I think that's fantastic. We're still talking about capital raising. What's the biggest mistake sponsors make when presenting a deal to investors?
I hope they keep making those mistakes. From deals that I was presented, because I'm presented a lot of deals as an LP. We have like a group of equity partners. We're always being reached out by other GPs that want to collaborate with us. The biggest mistakes that I've seen are overestimating their metrics, their assumptions, and only saying good things. If you just tell me the good news and the upside, I'm going to assume there's only downside. When sellers, even if you go to a car dealership and someone tells you, you're not going to like this, your trust in that person grows. I don't know the psychology reason behind that, but you do trust operators that share their bad news with investors. I met with some investors in Palo Alto last week, and they asked me, please tell us about your bad exits. Like, yeah, I mean, our average IRR is plus like 25% IRR, but not all of them are going to be like that. We had one that was a 10% IRR. Are you going to invest in a 10% IRR? No, but we had one. I'll give you an example. I lost money on one. So it's a negative IRR. That's part of track record. It's like asking someone for experience and not expecting a mistake. Someone with experience will have mistakes. So it's like someone asking you, well, what has been your biggest mistake in being afraid of it and not sharing? That's just sketchy. So it's all a matter of trust. So that's the biggest mistake, not sharing the bad news, because that's that portrays you as shady and sketchy. People want to invest with people that they trust and that they like. At the end of the day, like real estate is very common sense, connecting dots, everything is simple, everything is human relations. And that's one of them.
Eitan, let's talk a little bit more about the downside. How do you communicate downside without scaring away capital?
Being upfront and transparent. It's not easy to share bad news, but you have to. You have to. It's, I mean, and how? By calling, texting. We have a newsletter. We have a monthly email that goes to the investors. We have updates. And we say, listen, our projection was this. We got this. And sometimes it is what it is. You cannot. And by the way, when we present a deal to investors, the first thing that I say, do not invest money you cannot afford to lose. It's real estate. Things can and may go bad. We cannot control wars, interest rates, COVID. We try our best to mitigate risks, but there's going to be always risks. But stuff happens.
Absolutely. Let's talk a little bit about retail and industrial fundamentals. You've written about traffic counts not equaling customers. Walk us through your three-legged stool framework. You like this, don't you?
You did your homework. It's like you're reading from every post that I put. And I'm glad that you're doing that, because with AI, people think that people might think that everyone that posts stuff on the social media now, it's from ChatGPT. But I did start posting before ChatGPT. People just haven't heard my voice, or I don't have like an American accent, so maybe not everyone will resonate with everything with what I say. And it's on my first or second language. So when I say things, I might not say correctly. So I sometimes use Grammarly to help me with the grammar, but they're stuff that I post. So I appreciate you reading those. And as far as the fundamentals for like retail, you mentioned the visibility, it's not always equal to customers. Right. I mean, you can pass in an intersection with like 100,000 vehicles a day, and you pass by a nice looking shopping center. You see it, the foot traffic is there. Even the people at the shopping center can see all of the potential customers passing by. But if there isn't any exit nearby, I mean, even me as a driver, seeing that shopping center, there is a tenant that I'm looking for. Let's say PetSmart, but I'm looking for some type of pet type shop. I'm not going to wait for like 5 miles for it to just get into that shopping center. I'm just going to search for the nearest one or whatever Google Maps will tell me. And same with visibility. Like you can have foot traffic, but if you don't see the center, so you need to have the customers there passing by and have the ability to improve the visibility. So if there are many trees that are blocking the view, that's an easy fix. But if there is a new development coming up, or like the Department of Transportation decided that they're going to put a rail next to your property, that property is going to be worth $0. And it happened to us in one deal that we were underwriting for so long. I went to the property, I leave the property, I shopped at every single business in that shopping center. I went there to see how the traffic looks at night, in the morning. And then the broker told us, and I appreciate that broker, that the Department of Transportation is looking to make a big of a change there that is going to impact the accessibility to the shopping center. It went from like us being in best and final to dropping the deal completely and not working out not we made an offer at like 7.5 cap. Even at a 10 cap, it wouldn't make sense. Yeah. So fundamentals are important. It's like safety. If let's say I can show you the best area, not the best area, sorry, a good looking shopping center, concrete build with good foot traffic, parts of or the city is moving low income demographics to this certain area, and you see that the crime is going up, you're going to either drop the deal or submit a different offer, because that's going to affect the type of tenants that you bring. One thing that I ask, and I'm getting on like a tangent, but the most important thing for me is, at least in retail, not in industrial. In retail, I want to be able to walk there safely at night. So that's fundamental.
Nice. Can you walk us through your three-legged stool framework?
Mostly visibility, accessibility, and can I bring tenants to the center?
If you're analyzing a retail center in 2026, what are three non-negotiables
For retail deals,
for retail?
non-negotiables. They have to be in a good market, like location. It sounds sketchy and cheesy, and I don't want to say it. I like the location, location, location. It's all about where it's located. It can be a rough property. It can be a property distressed, low vacancy, low occupancy, and needs a new roof. But if it's located in a growing market, let's say if there's a new school coming up or a new company, like let's say Palantir just moved their headquarters to that area, let's say Aventura, then that's a market that I would love. Obviously, the prices are going to go up, but the non negotiable, it needs to be a market that is either very stable or growing, and that the either current tenants or potential future tenants of the property align well with the demographics.
If interest rates stay higher for longer, what breaks first in retail underwriting?
Right now, we can make deals work no matter what type of interest rate. A good deal is a good deal because we can make something work. On an institutional level, obviously, deals that are core to core plus type deals, every single basis point changes the value of the properties a lot. But in the value add world, deal can be done and deal can pencil with a 6.5 interest rate or a 6.25. It doesn't move the needle as much because you're accounting for some type of distress in the property, and you're looking at a dollar per square foot. Also, at that level of deals, you can either get seller financing or get more creative. We haven't, I mean, obviously, I hope the interest rates don't hike like 200 basis points in one day. It creates a lot of volatility, but you never know. With so many things happening in the world and in the Middle East specifically, things can change. And again, that's what I tell investors before they invest in first minute of presenting a deal. Like when I make a webinar and send it to investors, tell them do not invest. Like it's do not invest if you don't cannot afford to lose the money. Like invest, please, but it's a risk.
Of course, let's shift gears slightly. You outline 9 steps to closing a deal. It's not easy. Where is the most friction in that life cycle?
The most friction may negotiating a contract, because at the first step is the hardest, because you want to offer the lowest price, the seller wants to get the highest price, and justifying your price helps bridge the gap, but that is the most difficult one.
Absolutely. We're talking a little AI leverage now. If you could compress one phase of acquisitions by 30% without increasing risk, what phase would you choose?
Great question. Analytics. So, in like the real estate transaction, and from buying to selling, you have acquisition, asset management, leasing, capital raising, allocation. Analyzing a deal can take a long time. Like we have Argus, if I have an Excel with like the rent roll and financials, I can build an Argus in less than an hour. but that's one deal, and deal changes. And there are 10 deals that we're looking at once. Man, we have 4 deals on almost under contract at the moment. And by the way, it's the 4th of March and we closed already on 2 deals. And we're very active. So having a AI help us with the metric output, because at the end of the day, it's the same math. Argos, okay, I don't see AI getting replacing Argos yet, but I don't want to have to use different models of Excel. Maybe every company in our industry can use the same Excel because it should be the same cash on cash. I mean, it's the same calculations. You plug, okay, you engineer your cash flow output from Argus based on every operator's or sponsor's market listing assumptions. But that output, that cash flow output from Argus can be dumped into the same model that every single operator can have because it calculates the same metrics. I don't see why every operator has to have a different model and show different. I mean, AI should be able to ask you, what are the waterfall structure? Like what type of GPLP split do you have? What type of preferred return do you offer? But it should be the same calculation. It is the same calculation. I just want to be able to just put the Argus cash flow output in one AI thing, and it will give me this is the cash on cash, this is the IRR, and you'll be able to pay a pref by year 2. Bingo. That's one thing. The other one is following up. So I'm not sure if you're aware or not, but we're in the follow up business and then real estate. A broker might be very good friends with you. He likes you and trusts you, but you haven't talked to him in 3 months. And your competitor talked to that broker yesterday. So he has him in his back of his mind. So he'll send him the deal before he sends you because maybe he forgot. If you have AI help you with following up to not only brokers but investors, but GCs to get better bids for the capex projects. Also to what's the name? Okay, help you with renewals. Oh, helps you with renewals. Help you with okay, let's say investor relations. Help you get where the most events are for your strategic path. Let's say, Eitan, there's an investor summit in West Palm Beach this month. I'm scheduling one for you. And by the way, you already have a ticket. Great. But analytics, then following up, and what else? And I think that's about it. Maybe later on we can talk about robotics and AI, maybe helping with power washing, landscaping, and whatnot.
Amazing. Where are you still using spreadsheets and manual workflows that feel inefficient?
Yeah, those feel very inefficient. I mean, underwriting, I just have to go to Argus, then click on reports, then put in like Argus output. It takes too much time.
If you had a single acquisitions dashboard that showed you risk in real time, what would it need to display?
So two AI startups already reached out. I even gave my 2 cents on that subject. It's tough. Like I would love to have an AI assess the OMs in my inbox and tell me this is something worth pursuing. This one just needs a rejection email because X, Y, and Z. And maybe categorize that by color. Green is worth reviewing. Red is just reject. Maybe by criteria. Like, okay, this one is a 20,000 square feet multi-tenant retail in a location that you like.
That would be amazing. What would make you immediately reject an AI tool for acquisitions?
If it takes longer to understand that AI than doing the work yourself.
Yeah.
ChatGPT is very easy. You talk to, I mean, I talk to Gemini live and then By the way, I walk the property with Gemini Live, and it tells me like rough estimates of capex needed, but there it's very intuitive. So an AI system, any AI system that we would be open to using, it needs to be intuitive. It needs to be easy to use. If not, then we're not going to use it. We don't have enough time.
Amazing. Eitan, where do you see AI in, say, the next year or 2 years or even 5 years?
Implementing those changes in underwriting. Sorry to say this, but acquisition analysts have to jump on this AI wave quick. They don't have much time. Accountants as well. Starting jobs are going to disappear. So if you don't know how to look at the big picture of a real estate transaction from like a macro level, AI is going to take your job, but AI can and will improve your job and help you learn things faster. So I think employed people will embrace AI more and into their lives. Property managers, again, taking pictures and getting an assessment real quick. As even acquisition, I take a live video to see capex requirements and investor relations. That's something that, besides following up with people, you will always have to have like this relationship based connection. So, golf, playing paddle, pickleball tennis, swimming, running with investors and making them friends, that's going to stay the same. So, the future is bright to whoever sees in six opportunities.
I love it, Eitan. Let's talk a little bit about a lightning round. You ready to have some fun?
Sure.
All right, quick hits. One underwriting metric you trust the most.
Cash on cash.
One red flag you never ignore.
Not sharing bad news.
That was great earlier also. Most overrated metric in retail acquisitions.
IRR.
That's most overrated?
I mean, it's speculation. You're speculating an exit cap based on comps. Obviously, there are many comps and you can justify it, but at the end of the day, IRR is a speculative and a little bit over. I prefer cash on cash.
Biggest hidden risk in single tenant deals.
The tenant not renewing the lease and having a vacant space.
Capital prefers blank right now.
Track record.
You said that earlier. One belief about retail most people misunderstand.
Visibility doesn't equal customers, or foot traffic doesn't equal customers.
Last one, conviction in one sentence.
Knowing your numbers and your market better than the seller.
Love it. Eitan, for brokers, operators, and investors listening, where's the best place to connect with you online?
I'm a real person on LinkedIn. I post my own stuff. I reply to the messages. I try to. I sometimes I get a lot of messages, so it's tough. So if you don't hear back, follow up. If you're offering a service that I don't need, I'll just say that I'm not interested. But connect with me on LinkedIn. I'm a real person. I'm in Atlanta. I'll be moving to South Florida very soon, and I can meet for a coffee as well. But LinkedIn is the safest way.
Fantastic. Eitan, this was discipline, fundamentals, first real estate thinking. For everyone listening, if you're deploying capital, sourcing deals, or trying to win in a tighter market, this is what conviction sounds like. If you got value from this episode, share it with an operator who believes underwriting is a competitive advantage. We'll see you on the next episode of the AI Edge podcast. Thank you, Eitan.
Thank you very much. I appreciate the time.